A single shift in perspective can turn a $10,000 liability into a $10 million asset. While most observers see only the surface-level data of a failing venture or a market downer, elite performers utilize a cognitive tool known as strategic reframing to uncover hidden capital. This analysis explores how the world's most successful executives and investors transform obstacles into competitive advantages through a specific, repeatable mental framework. Over the next 8 minutes, the mechanics of this high-income skill will be dissected, revealing how perspective alone acts as a massive multiplier for both professional influence and long-term wealth accumulation. The following data points suggest that perspective is not just a soft skill, but a measurable economic engine. The foundation of strategic reframing lies in behavioral economics, specifically the principle that value is rarely an objective constant. Studies in prospect theory indicate that the average individual experiences the pain of a loss twice as intensely as the joy of an equivalent gain. This inherent bias often leads to risk-averse decision-making that leaves millions of dollars on the table during critical negotiations or market shifts. When a person views a 20% market correction solely as a loss of net worth, they are effectively blinded to the 20% discount on future cash flows. Reframing allows an operator to decouple the emotional reaction from the economic reality, treating every data point as neutral information rather than a personal setback. By shifting the lens from "what have I lost" to "what has this made cheaper," the strategic thinker gains an immediate psychological advantage over the competition. In the corporate world, this manifests as the difference between a company that treats customer complaints as a cost center and one that reframes them as free R&D data for product development. One path leads to an eroded margin, while the other leads to a refined product with a higher market share. Data suggests that firms prioritizing this cognitive flexibility see a significant correlation with long-term resilience, especially during periods of high inflation or sector-wide disruption. The ability to recategorize expenditures as investments is often what separates a stagnant small business from a scalable enterprise. But here's where it gets interesting. The most profitable applications of this skill aren't just about survival, but about massive pivots in the face of absolute failure. Consider the historical case of a failing video game venture that was burning through its remaining venture capital with no clear path to profitability. Most founders would have seen the end of the road, yet the leadership reframed their failure into a discovery process. By observing how their internal team communicated during the game's development, they realized the communication tool itself was more valuable than the game. This reframing transformed a dying asset into Slack, which was eventually acquired for $27.7 billion. This is the essence of the pivot, a term often used in Silicon Valley that is simply a large-scale application of strategic reframing. It requires the emotional detachment to see that a $500,000 investment in a failed project has actually purchased $500,000 worth of market intel. When the context changes, the value changes. An empty warehouse in an industrial zone is a liability due to property taxes and maintenance, but when reframed as a last-mile fulfillment center for a global e-commerce giant, its valuation can triple overnight. The IRS reports that many high-net-worth individuals utilize these shifts in asset classification to optimize their tax exposure and maximize capital efficiency. It is a matter of looking at the same set of numbers and finding a more profitable narrative within the bounds of the law. The data tells a different story once the framework shifts from the micro to the macro, specifically when it comes to high-stakes human interactions. In the world of high-stakes negotiation, reframing is the primary tool used to bridge the gap between a buyer's maximum offer and a seller's minimum ask. The most effective negotiators rarely argue over the price itself. They reframe the terms of the value exchange. If a CEO is presented with a software solution costing $500,000, they often perceive it as a massive expense to be minimized. However, if the service provider reframes that cost as a proactive measure against a potential $5 million data breach, the $500,000 becomes a 900% return on investment. This is known as loss aversion reframing. By focusing the counterparty on the cost of an action rather than the cost of the acquisition, the perceived value of the deal shifts dramatically. The asset hasn't changed, but the mental category it occupies has. In real estate, a developer might reframe a dilapidated historic building into a limited edition luxury conversion opportunity. This shift allows them to charge a premium based on scarcity and character, rather than competing on the commodity price of square footage. Research into successful deal-making shows that those who can successfully reframe the problem of a high price into the solution of a high ROI close 30% more deals on average. It is the language of the C-suite and the wealthy mentor alike. However, to truly master this skill, one must move beyond individual deals and begin to reframe the very way they scale their operations. To institutionalize strategic reframing, top-tier firms implement what is known as a pre-mortem session. In this exercise, the team reframes a current project as if it has already failed in the future, then works backward to identify why. This reframing of time turns a potential disaster into a series of current data points for mitigation. It allows for the preservation of capital before a single dollar is ever placed at risk, creating a culture of proactive rather than reactive management. Another powerful reframing technique used by high-net-worth individuals is the opportunity cost filter. Every hour spent on a $50 per hour task is reframed as a $950 loss if that individual's true high leverage rate is $1,000 per hour. This cognitive shift forces the delegation of low-value tasks and the hyper-focus on high-leverage activities. It transforms staying busy into managing an investment of time, which is the fundamental driver of exponential wealth growth. When applied consistently, strategic reframing becomes an automated process. An unexpected tax increase becomes a catalyst for restructuring for global expansion. A key employee quitting becomes an opportunity to automate their role and increase the net margin. The data confirms that the most resilient economic actors are not those with the most resources, but those with the most flexible mental models. They do not see the world as it is, but as it could be recategorized for maximum utility. The ability to recategorize a situation from a threat into an opportunity is the fundamental bridge between stagnant operations and exponential growth. If this analysis of cognitive leverage provided value, the next examination of capital allocation strategies offers a deeper look into elite executive decision-making.